Hey everybody, welcome to this edition of Chuck and Off Finance. Hope everybody's having an absolutely amazing day. I am your host, Chuck Fulkerson. We're doing our first, it's a live show. We've never done a live show. We're on live. This is scary.
I don't know. I do what we always do. I
got
my coffee. I'm ready to go.
Well, you know, I might say things that get me in trouble. I've been known to say things that get me in trouble.
There's no editing on this one.
That's a very, very, very good point. There's no editing, so you know it could get in trouble. So thanks to those of you that are joining us. Good to see those of you that are watching us on YouTube or Twitter on our at IIE Financial. If you've got questions, by the way, we can actually take them live. So if you've got questions, feel free to tweet them in. Just use at IIE Financial, and we'll do our best to answer whatever questions that you might have that come up over the course of the show. But what we're going to do is we're going to do the show like we do each and every week. We typically have four segments. Segment number 1 and 2, we're going to combine them today. But segment number 1 is we just kind of talk about what happened in the markets last week and what's going on overall. And in general, segment number 2, we really go into the headlines and we find some news and some information. And I got some really good news this week. Some news of the weird that will blow your mind. Like
I
literally,
know you kept this one a secret again this week.
You might have to wipe your brain off the walls. You might have to wipe your brain off the walls. It's so good. But anyway, and then segment 3 is our education piece. Today in our education piece, we're going to talk about upgrades and downgrades a little bit. Today there was a downgrade to Tesla, which, funny enough, we talked about on the show last week.
We did.
There was a downgrade to Tesla. And what does an upgrade mean? What does a downgrade mean? Why is it important? Why does anybody care? And then we're going to wrap the show up by talking a little bit about, what does the new tax cuts have to do with Medicare and Social Security? You know, somebody the other day said that Social Security was an entitlement. Entitlement my assets, right? Because we pay into Social Security all our lives. So I don't consider Social Security an entitlement system if you've paid enough into it. So we're going to talk a little bit about that in the 4th segment. So let's go ahead and just kind of dive right in overall. So the markets last week, we typically do this show. We try to have this thing out on Wednesdays. The markets last week had a strong move down on Friday. Strong move down on Friday on news of Michael Flynn and his testimony against the president, and then there was the wait a minute, we're just kidding moment where the markets just rebounded right up. And when you look at what the markets did, and you look at a chart of the S&P, and for those of you that listen to the show or watch what we put out on YouTube every day, I put a daily video out on YouTube. The markets reacted pretty, I guess the word would be predictably in that scenario, because it turned around twice at levels and areas where we had seen a fair price and a balance between buying and selling. And so one of the things that we look at when we look at the market is, where are those fair price areas that we can use for accumulation and distribution of securities? And we do that pretty much in the whole market. But there was all this, but the market's just so resilient. It just continues to go up and up and up.
And that's what we talked about last week in our planning segment. Pretty much every week we talk about, to a certain extent, we talk about the your line in the sand and not having a specific, or I should say random percentage, right? Because if you had a specific percentage, rather than looking at those fair price areas, there's a pretty good chance that you might have gotten wicked out.
There's
only the market to just come right back to
there's a good chance you got smoked like a cheap Cohiba as it came down, stopped you out, and then went the way you thought it was going to go anyway. And a lot of people had that happen, right? I think that that's pretty common. And I talk to a lot of people that's exactly what happened to them. So when you look at it, and interestingly enough, we have. What's kind of neat is that at IIE Financial, it's not just us. We've got a team behind us, and they kind of help put together some of our information and stuff. And I was reading something that David had put out, which is our I guess you'd call it the chief investment guy. And he's we make the decisions on the actual investments, but he does a lot of the fundamental stuff behind it. And he's put something out that I thought was interesting. He said, prior to the financial crisis, this is interesting, household debt relative to federal government debt. So household debt relative to federal government debt hit a high of 3 to 1. So essentially we had 3 times the debt in the household that we did in the federal government. Okay? Since then, there's been this combination of credit tightness, consumer prudence, just getting a loan has been much, much harder. We've had very limited growth in household debt. Household debt's actually not grown as much as you'd imagine. However, now federal government debt, whereas home debt has gone up 4%, federal government debt's up 150% over the same period. So now it's flipped, and we're in a situation where U.S. government debt is significantly higher as far as a ratio than personal debt. It's the first time that's happened. Now, why is that? Well, we've got a $25.5 trillion deficit, and it all becomes more probable of a tax increase and spending cuts in the future. Is really what it looks like. And everywhere you look, people are talking about taxes and what it's going to do and how it's going to affect. And I'm not here to talk about taxes. I'm not here to talk about what I think the tax code is, or if it's going to be good or if it's going to be bad. I don't talk red. I don't talk blue. I don't care about any of that stuff. What I care about is, what is your plan so that none of that matters to you and your family in the event that the market reacts unfavorably to these things? Because that's really the fear, right? I think the fear that a lot of people have is that their life savings, the thing that they've worked their butts off all their lives, is going to work their assets off. Their entire life is going to be affected by what happens in Washington, or by the people that are making the decisions that they may or may not agree with, right? And so, and we've already seen that the market is very, very sensitive to news. I've spoken to probably 5 to 10 either clients or people that are, that might be clients or whatever in the last 2 weeks. And without fail, all of them have said, I am afraid. If there's one word I would characterize most investors right now, it's fear. And the fear is that the bubble is going to burst faster than they can react.
Right.
That's the fear. People are running into this problem that they think the bubble is going to burst faster than they can react. And if that bubble bursts faster than they can react, what are they going to do? What are they going to change? And that, I find it when people have I guess the word would be, when people have an unnecessary fear, and I'll call it an unnecessary fear because there's nothing you can do about it. You just have to protect yourself in a way that kind of keeps you grounded. And if you protect yourself in a way that keeps you grounded so that you don't expect to get 20% more than the market. If you're trying to get 20, 30% more than the market, good luck, right? But you got to have protections on the other side. You can outperform the market. A lot of people do it, but you got to have protections for the downside. And that's where I think most people fail.
And fear also drives us to react in an emotional manner as opposed to following a quantitative plan. And we talk all the time about having that line in the sand and having the plan so that you don't overreact. And fear just exacerbates that.
That's all it does.
That emotional reaction to the market.
Fear just makes people overreact in a way that they're just not comfortable with.
And that costs you money.
Yeah.
Too.
Yeah, there's nothing more expensive than fear. And what's funny is, and I had a mentor tell me this one time, he goes, fear doesn't exist. Fear is not real. Fear doesn't exist. Fear is in your own head. It doesn't really exist. All that exists is a condition, and it's how you react to it.
It reminds me of, so our son is 3 years old, and one of our sons, and he just started gymnastics. And he scares
the crap out of me.
And he's got a coach that works with him one-on-one, and the coach right now is he came out at the end of class one day, and he said that he was afraid to do a couple of things, especially when it comes to like the high bar. Like he put the 3-year-old up on this super high bar, like the 12-foot bar, and John was reluctant to do that. And he said, the thing I'm teaching him right now is that fear is irrational.
Right.
There are dangers, but if you know how to approach those dangers and how to accommodate those dangers, then it's just another thing to get through. It's just another thing to execute. And so right now he's just teaching him how to overcome that, that fear, and to teach him that it's irrational. And I think that's just not applicable to gymnastics and teaching a 3-year-old. That's applicable to everything.
It is.
An irrational response.
Right now, fear is an irrational response to the market. I spoke to a gentleman a couple of weeks ago who's been out of the market since '08, and he's watched this thing continue to climb, without the comfort level of at some point trying to get in, right? And what's funny is, there's the old I think it was Joe Kennedy that said it's time to get out of the market when your shoe shine boy's giving you stock advice, something along those lines. I'm paraphrasing here a little bit. But people that never, ever, ever talk about the stock market, when they start talking about the stock market, it's time to be aware, right? It's time to put your little ears up so that you have some awareness, but you don't want to overreact to that, right? And if you overreact, that's where you make mistakes. So here's what I say. Number one, where is your line in the sand? And I'm not talking just about your IRAs or your individual retirement accounts that you got money. What about your 401k? See, I was speaking to somebody last night, and he and I were talking about his individual account that he's got, in a brokerage house somewhere, but also about his 401k. And I said, well, part of what we want to do is not just manage your individual money, because that's important, right? We help our clients manage their money, and we help them, and we come up with a plan and something that makes sense for them. But what about their 401k? See, our clients have to manage. We're not going to tell them not to be in their 401k, especially if they're getting the match. However, when the market goes down, when do you move those funds, or which funds should you be in? And if you have a plan for it, there's no reason to have fear. I talked to a client a couple of weeks ago who had all of his money in cash, and he's had it in cash for a long time in his 401k. So all he was getting was the employer match, and he's missed out on something like 200% in the S&P in that period of time. So just what I say is this: fear is irrational, but having a rational response to movement is what you want to have. And the plan is, where is your line in the sand? So if you've got questions, if it's something that you want to talk about, or if it's something that you're interested in learning more about, give me a call, 832-953-4998, or visit us online, iiefinancial.com. We're going to take a short break. When we come back, we're going to talk about the news of the week, and specifically the news of the weird. You're listening to Chuck and Ann on Finance. We'll be back right after this. Do the second segment now.
All right, I'm pulling up this news of the weird since
it's good. Oh,
it's good.
Hey everybody, welcome to this edition of Chuck and Ann on Finance. Hope everybody's having an absolutely amazing day.
All right.
Kept it secret. Kept it a surprise.
It's a good one.
Let's pull this up. Oh, that's a good one. Especially since we just had a supermoon 2 weeks ago.
All right, almost done. We're getting there. Those of you guys that are watching us at home, we're getting there, I promise. All right.
It's behind the scenes publication.
I know, this is what it is. We record one segment, and now we start another one. All right.
You doing okay on coffee?
No, I'm not. Can we put some bourbon in my coffee? Hey, for those of you that can see at home, it says, "Life is hard. Bacon helps," in case you're wondering. All right. Hey everybody, welcome back to Chuck and Ann on Finance. We are rocking, we are rolling, we are having an amazing day. It's actually kind of gray outside.
It's been raining for 3 days.
Yeah, it's been raining for 3 days. I think Noah may come soon. No, we don't want to talk about that here in Houston.
No,
it's not. It's just not worth joking about in Houston. It's been a rough year for many Houstonians. So anyway, glad you guys were able to make it back. You're listening to Chuck and Ann Finance, brought to you by IIE Financial. IIE Financial, willing the good of another. Visit us online, iiefinancial.com, or give the office a call, 832-953-4998. That's 832-953-4998. We're in segment number 2, and in segment number 2, we talk about the news of the weird. As our first news study.
That never gets old.
No, it's awesome. I was gonna record a little sound drop for that.
You don't have to.
Nope, I'm just gonna do it myself.
Keeping it real.
S&P's coming down nicely off that level. Anyway, sorry, talking to myself. So, Mara, you know, when we talk about our news of the weird, I got a couple of headlines that we're going to go, but the first headline is a big one. This is huge. And this is mostly huge because I've always believed this. I have always believed it. I have always thought it to be true. A former manager of the DoD Aerospace Threat Program. DoD. That doesn't stand for anything more than Department of Defense. So this guy's with the Department of Defense. His job was to create missiles because it's aerospace. And he says, open quote, UFOs are real. Close
You sure he
quote.
wasn't like the manager of the custodians?
No.
Was it like a real manager?
No. The team includes a 25-year veteran of the CIA's Directorate of Operations, a Lockheed Martin program director for advanced systems at Skunkworks, and a former deputy assistant secretary of the Defense for Intelligence.
All right.
This is at a, I guess it's the Stars Academy of Arts and Sciences, and he says that UFOs are real. What do you think about that?
I think that there are many things that could be unidentified flying objects.
UFOs are real. Aliens, little
Anything
green.
that flies
I
is
believe
an
in-
object and you can't identify it is a UFO.
No,
so.
I believe in the grays. I'm just going to tell you right now. I believe in the grays.
Yeah.
I believe people. There are too
I
many.
have no position. I neither believe nor not believe.
I believe in the grays. I do. The little men. They're short though, so like if they come, I could kick them. But they. So I've heard they're short. I'm pretty sure they're short. But my fear is they've got some advanced alien technology that would just wipe me out.
Probably.
Because if they got here, think about it.
We just watched the Marvel Agents of S.H.I.E.L.D. 2-hour season premiere.
No, don't spoil it. Don't spoil it for anybody. Spoilers. Hashtag spoilers. No. See, when you think about with Star Trek, right? Star Trek, 5-year mission to explore strange worlds. When you actually think about that for a minute, think about warp 10 for a minute. Mm-hmm. So warp 10 means you go 10 times the speed of light, mm-hmm. right? Well, if you go 10 times the speed of light, that means you'll go, what? 10 times the speed. So if you go 5 light years away at warp 10, seems pretty quick, right? Where can you go in 5 light years? Nowhere! Nowhere! Right? So even if you go warp 10 and you're gone for 5 years, you're going to go, what, 5,000 light years? You're getting nowhere. You're not even going to get to Pluto, let alone the deep space. So anybody who comes here, they're smart. As they say in Boston, wicked smart. And I would be worried. So just in case you're wondering,
that's why we have super cool telescopes.
If there is an alien invasion, just so you know, I will turn sides in about 3 seconds. I will join the other side to stay alive.
Well, that's why I worked for years for the Navy, trying to launch that nuclear probe to go to Jupiter because humans aren't getting there.
I will switch sides to stay alive in a heartbeat.
I don't know. We had some pretty cool technology.
Turncoat. Nope, turncoat. Benedict Arnold. I will be Benedict Arnold. I will turncoat like that. I will turncoat like that to stay alive. All right. So that is one of our news headlines for the week. My favorite one. The other one is that just came out today. This was on MarketWatch.com. Senate Banking Committee overwhelmingly backs Powell to lead the Fed. Senator Elizabeth Warren is the lone dissenter. No surprise there, right? So Powell was backed by all of the panel's Republican and Democrats, except for Senator Elizabeth Warren, a Democrat from Massachusetts. Warren said she disagreed with Powell's statement in his nomination hearing. There was no danger of banks that are too big to fail. So, she's not, she thinks that it'll roll back some of the rules that were set before the financial crisis. So that's her fears, that we'll roll back some of the things that were put in place during the financial crisis to protect individuals. What I say is this: some of those things that were put in place to protect individuals during the financial crisis were overkill. And
ended up hurting consumers.
Absolutely. Anybody who tried to, let's put it out there. We have pretty good credit. we've done pretty, we're pretty smart with our money. Well, you're pretty smart with our money. We've got pretty good credit. We do fairly well. Everything's just fine. We had and if you remember this, we were buying a second property in Arizona, and we were going to mortgage it. We were going to get a mortgage on it because we thought, oh, let's just, rather than buy it, let's get a mortgage. And we were looking at that, and it was like pulling teeth to get approved for the mortgage. It took like 3 weeks. Finally, we said stop the application, which they didn't like that, but oh well. Finally, we just said stop the application. We'll just pay cash for it. We were tired of fighting for it. But the point is, they made it so hard to get a loan that maybe rolling back some of those things is not a bad idea. Maybe rolling back. See, I am not a believer in over-regulation, and I think one of the things that a lot of Republicans are happy about this Powell is that he's a little bit more focused on how to make things easier for the private sector. So whether you are, once again, I don't speak politically at all. I don't care what your political affiliations are. I don't agree with one side or the other overwhelmingly. Let's put it that way. But I do agree with this. The more barriers you can remove to getting business done that doesn't hurt people in the long run, the better.
Absolutely. It's always that way, though. I mean,
right.
the less red tape. I've worked for the government, and I've worked in the private sector, in managerial positions, and I can tell you the amount of red tape. Not that there's no red tape in corporate America, but
sure.
The amount of red tape that there is in the government is maddening.
And the Fed, the Fed is designed to essentially to keep the U.S. dollar as a valuable commodity, right? That's really what it's supposed to do, is keep the U.S. dollar as a valuable commodity. And as the Fed chairman, what will he do? Well, there's been a lot of talk saying that he will speed up the interest rate rising, that will speed up the raising of interest rates. But second headline of the day, also on Market Watch, it says new research suggests that the Fed has no reason to keep raising interest rates. Coker Locata says, and I don't know who Coker Locata is. Naranja Coker Locata, a former Fed official. I hope I'm saying his name properly. I'm probably completely blowing it out of the water. But he says that the U.S. Central Bank is leaving money on the table by following a dogma known as the Phillips Curve. And the Phillips Curve is essentially a theory from the late 50s, which holds that as the jobless rate falls, inflation rises. And it's still a framework that is personally useful. Janet Yellen said it's a framework that she personally finds useful, and so is using that as a way to justify raising rates. His point is, we don't need to raise rates. So it's interesting, if we get a new Fed chairman that's more aggressive on raising of the rates, will that stem some of our economic growth and some of our stock market growth overall? There's a lot of fear with people that where people's fear comes from is that a rise in interest rates will make the stock market drop because the market has gone up using interest rates as its drug, right? It's using those low rates and free money as its drug to continue to moving higher. And I think that's part of it. It really is. A lot of companies that you wouldn't think would benefit from this low interest rate environment are blowing it away with stock buybacks, right? If a company is doing stock buybacks and it's decreasing the shares that are outstanding, what's it doing to the price, right? It's jacking that price up. So since it's jacking that price up, it's artificially inflating the market cap of the company, which is what's leading to our overvalued position. Right? So when you think about how they all tie together, our overvalued position in the market is spearheaded by the lower interest rates and the stock buybacks. Well, if we get the tax cut, and this is the fear that a lot of people have with the tax cut, right? And I'm going a little bit off the rails here, but these all tie together. A lot of people that are opponents of the federal tax cut towards corporations, and the idea being, especially flow-through corporations are supposed to be the big beneficiaries of a tax cut, taking the tax rate from 35% on corporations down to 20%. And the idea on one side is that when we take the tax rate down to 20%, these companies are going to have more money, they can invest in R&D, they can invest in more jobs, and they can continue to grow, and it's traditional trickle-down economics, right? The other side of that coin is, how many of these companies with this tax cut are going to take that money and go out and just use that money to go do more stock buybacks, continuing to raise the price of their stock. It's a hard sell. This tax cut is a hard sell when the stock market's at an all-time high and company profits are at an all-time high. Well, the stock market's at an all-time high is a direct relation to the interest rates. And the interest rates have made stock buybacks that much stronger. Now, what happens is it becomes a self-fulfilling prophecy, or kind of like a snowball. Because as it starts to get better, more and more individual Americans that weren't investing in the market before now start dumping their money and dumping their money and dumping their money in, and it starts to snowball and it starts to go up at a faster and faster and faster and faster rate. This is a recipe for a bubble. That's what this is. This is the recipe for a stock market bubble. By the way, every bubble bursts, and we know it's going to come down at some point. The question is when. And I'm not worried about when. I'm worried about where. Where's our line in the sand so that when the bubble does burst, we know when to get out.
He also talks about the unemployment rate and how the Fed should see how low it can make the unemployment rate go. And I'm wondering, like, is that it? When he talks about unemployment, is he talking about the reported unemployment rate, or how many people are actually unemployed in the country?
Absolutely, the reported unemployment rate, which is completely different than the
because the employment rate that's reported is just the people that are receiving benefits, right?
Yeah, essentially, that are eligible for or currently receiving. You know, the one that I like to look at is under the Department of Labor. If you go to DOL.gov, the report is called the, now it's killing me. I don't remember the name of the report, the exact name of it. Essentially, it's the percentage of Americans that are actually working, and it is the job force. Oh, I can't think of the name of it off the top of my head. But anyway, what it says is that right now we're actually very low. Right, we're at a very low percentage of people that are eligible to work. They're actually working. You know, people that got laid off of their jobs 3-4 years ago don't show up as an unemployed person. They just don't show up at all in the numbers, but they do show up. Labor force participation, that's what it is. It was killing me. It's the labor force participation rate. And if you look up the labor force participation rate on the DOL website, you will get the current number. And I will, let's see, I'll look that up right now. And when you know what that is, those are the people that are actually working, that are of working age. So if you know the actual, it's actually at the BLS, that's the Bureau of Labor and Statistics. And if you look at a chart of this, we are currently, as of December the 5th, at under 63% of the civilian labor force, ages 16 and over, that's actually working. Under 63%, meaning 37% of the civilian labor force is not working.
Right. And he says this might spark a virtuous circle, getting more people involved in the labor market and spark more demand and capital investment, which in turn leads to more jobs. And my problem with that is that we know loads of people, especially in Houston, who are unemployed. They are not part of the unemployment rate because their benefits have run out, and yet due to their age, though no company will ever admit that they won't hire because of age, but whether it's because of age or whatever, they are unhireable.
Absolutely. And
so
I will tell you
he
right
says
now,
it'll
our
spark
labor
more people involved in the labor market. They're trying.
Sure.
So to me, that's where this whole argument completely unravels.
Our labor force number is right now the same as it was in 1978. Basically, we've got the same percentage of labor force now as we did under Carter. So, you know, and it went up all through the 80s, and from 1999 to today, it's continued to decline. We're the lowest percentage of labor since 1978. So just keep that in mind. Mm-hmm. So, all right, so let's do this. We're going to take a short break. We went a little longer than I expected to. When we get back, we're going to do our education piece, and we're going to talk a little bit about upgrades and downgrades and why those are important. You're listening to Chuck and Anna Finance, and we'll be back right after this. For those of you that are listening at home, thank you for joining us on the session today. If you've got any questions, certainly feel free to send us an email or give us a call, and I will hopefully see you all very soon. Thank you so much. Bye.